Okay, so I'm going to put down a formula here for free cash flow computation. I know all of you, you know the format. Not so? So free cash flow computation, what is our starting point? Operating profit. Operating profit. So once we take operating profit, what should we do? Let's start. And then what do we do? Then what do we say? What types of capex do we have? What capex do we have?
Maintain or replace non-paying basis.
The other one? And also so you see, because we are doing this question together for the first time, we need to put everything like this to help you remember how to calculate the free cash flow to firm. So this is how you get your free cash flow to firm. So in a free cash flow to firm, not all these may be given, but this is a very good prompt for you. Not all these may be given, but this is a good prompt for you. So let us go. Let's fill in. Operating profit, 192.3. Less tax. Less tax. What is the tax rate that is applicable in this particular question? Let's go. What is the tax rate that is applicable to a question?
20%.
Good. Here we are. So that's it. The tax rate that is applicable to both questions, to both companies, Depreciation, let's convert this to a cash flow. If company deducted tax allowable depreciation and other non-cash expenses totaling 112. It requires a cash investment of 98.2 in non-current assets and working capital to continue its operations. So, to continue its operation or to maintain its operations, together as the working capital, they have combined them. There's a figure of Okay. Those are not there. So all things being equal, what's the free cash flow? There we are. Now, what's going to happen for the foreseeable future? What are we told? 3 years ago, F company's profit after tax was 83.3, and this has been growing steadily for the current level. F profit before interest and tax and its cash flow grew at the same growth rate as well. It is likely that this growth will continue for the foreseeable future if F company is not acquired by C. F company's cost of capital has been estimated at 10%. So now we have an idea here of what sort of a future cash flow are we looking at. This brings you to these concepts. We have got a cash flow that will be growing at a constant rate every year forever. This is where the whole principle comes from. And when we're looking at the total value of the company, we take the free cash flow to firm after 1 year, less work minus G. This basically is just an adaptation of that. Do we have the work? Yes, 10%. What was the future expected growth? The information has been given here. They said 3 years ago, 2018, 2019, 2020, 2021. Here. So 3 years ago, 1 year ago, 2 years ago, 3 years ago, the English here is here. So 3 years ago, the figure was what? 0.3. This figure has grown 1, 2, 3. To what value? 192.3. So what is the average annual growth rate? And this is what we can expect in the future. So the average annual growth rate is calculated as what? Let's go. Point over the power, how many times? Minus 1 times 100. Let's find the answer. What is the average annual growth rate? What's the average annual growth rate? I'm looking for the answer. I'm waiting for the answer rather. Anyone with an answer? Anyone with an answer here?
$32.16.
32.16%.
Mr. Piri.
Yes, please.
Yeah, the question says 3 years ago, Foshol's company profit after tax was 83. And this has been growing steadily to their current level. So the profit after tax, the previous PAT was 91.
Profit after, not operating profit.
Profit
Not
after tax.
Okay. Not operating profit. I took it as operating profit. I took it as operating profit. The profit after tax was 83.3 after tax. So this is 91. Thank you for the correction. 91.0. Let's correct that one. Okay. Okay. The profit for interest and taxes here. It's here. What is the answer then?
So that gives us 2.99%.
And they're saying that its operating profit and its cash flows grew at the same rate. So when the cash flows also grew at the same rate, it is likely that this growth rate will continue for the foreseeable future, this growth rate. So meaning that we now have our growth rate, 3%. We have our cost of capital, 10%. And we have our free cash flow after 1 year, which is this one, brackets, 1.03. So with all these parameters now, we can do our valuation. So all things being equal then, the total value can be estimated. Let's estimate it. The total value equals 167.64 brackets divided by 1.03 divided by 10% minus 3%. Can we have the answer, please? What values are we coming up with? What values do we have?
So we have 2466.7.
This is the total value of the company. What does total value mean? That's the total value of the company. So value of equity equals, what is the proportion of equity in this company? Have we seen the value of equity, people?
Yes.
So the clue really to this question is that statement that we're supposed to use what? That was the clue to the question. One of the key learning outcomes is that all of you must be able to estimate the free cash flow to firm and also the free cash flow to equity. But the one which is more common in the, let's face it, is this one. That's the one which is more common in the exam. So now let's just put our workings together. Where are we getting? Where are we going to? Where we're going to is these two companies.
Mr. Pires.
Yes, please. Go ahead, go ahead, go ahead.
I was stuck on the English. I was looking for weighted average cost of capital. So is it the same as cost of capital?
Yes. The expression cost of capital means weighted average cost of capital.
Okay, I was stuck there.
Okay. So the value of F on its own, you have raised a good point there. What of C? If you remember at the beginning of this question, they gave you that value. Not so? Almost all these questions are modeled on the same. Almost all our questions are modeled on the same. Individual, companies, and also combined companies. This one was given in the question. This one I've calculated. Now we want this big one here, combined.
Mr. Piri.
Yes, please.
Another confusion or which I was looking at when calculating the beta was using 40 over 12,600. But I saw that it's not anywhere in the solution.
Which 40?
The 40 that you have used, the 40% of 246, but my line of reasoning was 40% of 12,600.
It's here. The company's current debt to equity of F is company F. It's company F, this one. Here. This company debt is 60. Equity is 40. So it's 40% equity.
So, Mr. Piri, sorry for asking too much. So,
go ahead.
Okay, sorry for asking again.
No, it's okay. It's okay.
So I mean that the equity value, I'm not saying so I mean that the equity value will be based on the new, on the free cash flow to firm that we have calculated.
Yeah, so what you calculated was the total value of the company. What you calculated was the total value of the company. So that was the total. So this was a value which was the value of debt plus value of equity. This one is 40% of that value. This one is 60% of that value. So what you calculated was the total.
Okay, so a step further in this calculation means I see that the total value is simply the formula of the free cash flow multiplied by the cost. Is it multiplied by? Is it multiplied by or divided by? Oh yeah. I don't know how you can explain whether multiplication or division there.
Are you looking looking at my annotator?
Okay, no, that's fine. I think looking at your formula, that's okay then. Thanks.
So the total value of the company is the free cash flow to firm after 1 year. This is 1 year. That is why I multiplied by 1.03.
Okay.
Then you divide.
So can we say that? Can we say that this is the new market value? This is the new market value that we have calculated.
What you have calculated is if this company continues on its own, if this company continues running on its own, the present value of all the future cash flows, if this company does not, if it continues on its own as an independent company, as an independent company, its value is what we have calculated here. This one. So if this company continues on its own, the value is this one.
Okay. Thank you very much for that explanation.
So if it doesn't do anything, it continues, they don't want to merge, this is what will happen. This one also, if they continue on their own, this is the value. Now from there, we pulled out the value of equity, which was this one.
Okay.
So if these companies continue independently on their own without merging, this is what they're going to get. We can even push in a value there.
Okay.
Let's push in a value here.
It's understood.
You know why? Because almost all the other questions, they'll be modeled on the same. So once you pick it here, even other questions will just be repeating the same. Now let's look at the combined company. Combined company, where are their details? Let's put in the values for the combined company. Let's go. Combined company is here. We now know the formula, isn't it? What formula am I talking about? The formula for the free cash flow. Now we have an idea of the formula, isn't it? Let's pick the values, people. Okay, so everything is here. Okay. It's important to really get involved. That's when you benefit a lot from the questionnaire. Okay. So the company has been combined. Once C acquires F, it is predicted that the combined company sales revenue before 2 in the first year, and this operating profit margin on sales will be 20% on the foreseeable future. They are giving you information to get free cash flow. So let us now start with the free cash flow for the combined company. Let's start with the free cash flow for the combined company. So how do we get it? We say, yes, year 1, year 2, year 3. How far do we go? Well, the information given will tell us. After the first year, sales revenue is expected to grow by at 7% for the following 3 years. 3 years. So let's put in the sales. So you go in year 1, 4.2. You take this one. It will grow for how many years? For the next how many years? Are we all happy with that? Mr. Nkunguru, the English there.
Yes, that's okay.
It's possible to miss it, you know. It's possible to miss it. What is the operating profit margin? 20%. That's the operating profit margin. Okay. Then your usual follows. What are those? Less what? Tax. And add depreciation. And less the capex. Now let's just check what has been given here. Let's check what has been given here. It is anticipated that after the first 4 years, the growth rate of the combined free cash flow of 5.6. We'll come to that later. The combined company's tax allowable depreciation is expected to be equivalent to the amount of investment needed to maintain the current levels of operations. Let's come here. Let's discuss it. Less capex. There's capex which is needed to do what? And the one which is expected to do what? What are they telling us about this figure and this figure? What are they saying? What are they saying about those two figures?
Yeah, the same in the net off.
Have they even been given? Have they even been given? They haven't even been given because we don't need them.
I was looking for them, but they have not been given.
This figure and that one is the same. It's in and out. The only one that they have given us now is which one? However, as the company sales revenue increase over the 4-year period, the combined company require an additional investment in assets of 200 in the first year, here now, to grow the company now. You need 200. Okay, and what will happen in the subsequent years? And then increase by 0.6, and then 0.64, the $1 increase for the next 3 years. So when there's an increase, where is the increase? Let's go for the increase. I'll make them a minus. So I'll say this minus that times 0.64. Have we seen that? Now, in the exam, if you got this one wrong, currently you'll not be forgiven. Why? This is a computation which has been repeated several times. What you see here, there's nothing strange, no. These are computations which have been repeated several times and not be forgiven if you didn't get them right. So in your computations, you can even remove these. Okay. Can you imagine that we are done already? What do we call this line? Then from there, what do you need now? Discount factors. Now, this is where the issue comes in. So to calculate the discount factors, what are we basically looking for? Go ahead.
Yeah, on tax, I calculated the tax correctly, but I did not follow what you have done. So I'm asking in the exam, because I started with the operating profit tag. I omitted the tax, I put the tax at the end after taking out the gross ops, because I'm thinking that tax is based on the operating profit, so it will still be the same, because this is not a question on investment appraisal. So still getting the same. Will there be some penalization?
Tax is supposed to come before. The capital,
but what if I include
the capital
it at
items?
The end?
You don't pay tax on the capital items, no.
But can I just combine like operating profit, add the depreciation, less tax, maintain what, and get 472?
Okay, fine. No, if it's a question of arrangement, no, it's okay. As long as you don't charge, because the capital allowances have already been dealt with. So you don't, no, that's okay. No, that's okay. If you get 4.7, 472, it's okay. That's all right. No problem.
Yeah.
No problem. No problem. Discount factors. So you're back to a nice topic called what? So for you to calculate what do you need? And what else? Then you need what? And what else? These are the items that we need. So what are we told? C pays interest at 5.3. That is your cost of debt before your taxation. It can be assumed that the capital structure of the combined company remains at C, a debt to equity ratio of 30/70. So debt is 30%. This one is 70%. So what is the only item that is missing here? What is the only item that is missing?
Cost of equity.
Cost of equity, when you look at the information given here, it leads us to no conclusion other than the capital asset pricing model. The risk-free has been given. The market risk premium has been given. The only thing from here, what are you looking for? What are you looking for from there? Yeah? What is the only item that you're looking for from there? It's a beta. All you need from there is a beta.
Yeah.
The beta is all you're looking for there.
Mr. P, are we looking for the, are we looking for the, we are looking for the equity beta, not the asset beta, but the equity beta.
You're looking for the beta of a combined company. That is step number 1. You're looking for the beta of a combined company. Is a combined company geared? Is a combined company geared?
Mr. P, that's why the issue is there. Is that the equity
Look at
beta
this.
or the asset?
So it's step by step. So is a combined company geared?
Yes, it is.
So what bit are we looking for? What bit are we looking for then? We're looking for an equity beta. You're looking for an equity beta. Have you seen the process we have followed? We're looking for an equity beta. Now they have given you a clue. What is the clue? It can be assumed that asset beta of the combined company is a weighted average of the individual companies' asset betas, weighted in proportion of the company's values of equity. So let us now kill our core question and conclude it. So now we are looking for a weighted beta. So we go. So we've got our 2 companies. Our 2 companies, C and F. And the asset betas, this one 0.8, and this one 0.8. What are the values of equity? C. And this one. So if we got that one wrong, then we're in trouble. If this 987 is wrong there, then unfortunately, we are in trouble. So let's do an averaging now. Averaging this multiplied by that. This multiplied by this. Okay. So that is the combined asset beta, 0.811. Then what do you have to do about this one? What do you have to do about this beta? Can somebody tell us what should you do about it? We have just identified that we're looking for an equity beta. So we combine this. So how do we combine this? How do we convert this to an equity beta? Do you remember how to do that?
Yes, you must.
0.811, eh?
Yes.
Multiply by what?
The market value of equity.
The market value of equity. Okay. What's the market value of equity? The market value of equity is what? 70 over 70.
The market value 70
plus 30. I like it that some people are able to guide us like this. I like it that people are able to guide us. Eh? This is excellent. This is excellent. People are able to guide us. So that is the ungearing part of it. Eh? Okay, let me just make sure that I put this correctly. 70. Okay, so let me just put this nicely here. All right, I think I must put it. Okay, no one is. So when you're doing it directly, this is the way it goes. 70 value of equity over value of debt divided by the value of equity. If some of you have forgotten, I can remind you. So if you want to get that straight, you take your asset beta, you multiply by value of equity plus value of debt, 1 minus T over the value of equity. So that's how you get your equity beta. And this is what we have done. Equity is there, debt is there, and that proportion is there, and equity is there. Okay. If some of you say, no, me, I take step by step. I still maintain this one. Then this is what I'm used to. There's nothing wrong. There's nothing wrong. You'll still be multiplying this one by the inverse of that one. So it still comes the same way. So what is the answer? What's the equity beta? Equity beta? Anyone with an answer? Anyone with an answer? I'm waiting for somebody to confirm my answer. I'm waiting for somebody to confirm my answer.
I also got 1.09.
Okay, so there's a confirmation there. Okay, so now let's conclude. Let's conclude, people. Let's conclude. Okay. There we are, 4.249.63. That's the cost of debt, cost of equity. And finally, the work, 70% comes from where? Plus comes from where? We can also get it from here. So this is the weighted average cost of capital that we are looking for. 8.01 or 8%. Eh? So you've got your costs here. You've got the other one here. Mm-hmm. So that's a small number looking for 8%. Eh? That's a magic number we're looking for. So let's discount now.
That's a small number that gave me problems.
Mm-hmm.
Because the questions we've been doing was the company is ungeared. So now this one is just dribbled me.
Mm-hmm. I hope now it won't dribble you again. Eh?
Yes.
There we are. So these are the values for the first 4 years. What of beyond? What of beyond? So what we're going to do now is we'll leave the question here so that everybody can spend their time to go and retype this and rewrite this before the next class. So I want to give everybody an opportunity, and the next class one discuss how do you treat the beyond? How do you treat the beyond? Is that okay, people?
Yeah, that's okay.
So we'll leave the question here. We want everybody to go back, sit down, and go through this question on your own again before we can conclude it. And answer whether there was the value creation or not. Okay, so that's where we'll leave our question today. Eh? So please, before the next class, find some time to go through this question. Eh? It's an exam standard question. Once you're able to do this question, then you can say, I'm okay. Do it again and again. And you're going to find what you learn in this question, you're going to use it on so many other questions. Remember, we haven't finished filling in this portion. So now we want to fill in this portion, but we only have part of the value. So we can't fill in here. All right, team, good night. I'm sure you are tired. You need to go and take a rest.
Thank you.
Thank you.
All right.
These questions are next to Dr. Ravi.